Are you wondering how one of Asia's largest commercial REITs has managed to stay resilient against global headwinds? Today, we're breaking down the latest second quarter results from Mapletree Pan-Asia Commercial Trust, or MPACT. Whether you're an investor eyeing stable dividends or just want to know how Singapore's flagship assets are performing amid market turbulence, this update is a must-watch. Before we dive in, make sure to hit subscribe so you never miss deep dive earnings breakdowns. Disclaimer: this video is created purely for informational purposes only. It is not financial advice and should not be considered as a recommendation to buy, sell, or hold any investment. Past performance is not indicative of future results. Please conduct your own research or consult a licensed financial advisor before making investment decisions. MPACT reported a second quarter distribution per unit, or DPU, of 2.01 Singapore cents. This is up 1.5% year-on-year. Net asset value per unit stands at $1.75 Singapore cents. Aggregate leverage is at 37.6%, within a prudent range. Total assets under management reached 15.7 billion Singapore dollars, covering 15 commercial properties spread across Singapore, Hong Kong, China, Japan, and South Korea. Gross revenue for the quarter landed at 218.5 million Singapore dollars, down 3.2% year-over-year. This mainly reflects strategic asset sales and currency effects. Net property income, or NPI, was 169.9 million, down 2.2%. Singapore, especially VivoCity, led operational gains and helped offset softer overseas results. Management highlighted Singapore as the anchor for portfolio resilience. In their words, Singapore's stability continues to drive long-term value, even as overseas headwinds persist. They are focused on protecting cash flow via strong occupancy, tenant retention, cost controls, and selective property upgrades. Recent Japan property divestments showcase commitment to core quality assets and financial flexibility. A major operational highlight was the upgrade of VivoCity's Basement 2. This new retail zone added 14,000 square feet, introducing top food and beverage tenants such as Din Tai Fung and Kikanbo. The project, completed in phases, delivered robust tenant sales and a return on investment above 10%. Mapletree divested 2 non-core Japan office buildings in August, directing proceeds to debt reduction and portfolio strength. Let's look deeper at the segment performance. Singapore remains the clear leader. In the second quarter, net property income from Singapore assets grew 6.1%, with VivoCity as the highlight. Tenant sales at VivoCity rose nearly 5%, supported by full occupancy and a robust rental reversion of 14%. Mapletree Business City reached 93% occupancy, though its rental reversion was slightly down, reflecting competitive market pressure. Overseas, Festival Walk in Hong Kong maintained high occupancy, but sales softened, affected by ongoing outbound travel and macro uncertainty. Japan's performance remained subdued due to market softness and divestments, with occupancy at 74%. The Pinnacle Gangnam in South Korea is a bright spot, with virtually full occupancy and stable income. How does this fit in the broader industry context? Retail and commercial property in Singapore stay resilient even as global risks persist. Government vouchers, robust consumer sentiment, and a gradual tourism recovery supported retail growth this quarter. Hong Kong and China remain challenging, hit by currency swings, policy uncertainty, and travel trends. Interest rates, inflation, and the strong Singapore dollar are the main macro headwinds management is watching. This impacts borrowing costs and conversion for overseas revenue. A big part of the strategy this quarter was portfolio optimization and risk control. MPACT's divestment of 2 Japan properties allowed redeployment of capital toward reducing debt, keeping overall gearing below 40%. Lower finance expenses helped buffer weaker overseas market results, reflecting the benefits of proactive debt management. As of September 30th, committed occupancy across the whole portfolio was 89%, a strong showing in the current climate. Let's take a moment to focus on MPACT's sustainability strategy. The trust has mapped 12 material ESG factors to global standards and committed to a climate-resilient portfolio. Its goals include green certification for all assets and a 33% green lease signing target. Recent initiatives include energy intensity reduction, ramping up solar capacity, promoting best practices for water and waste management, and a strong community engagement program. The trust aims for net zero operations by 2050, and its sustainability pillars underpin asset value, long-term stability, and stakeholder trust. Let's circle back to the outlook. Management expects Singapore to remain a safe haven in uncertain times. Portfolio optimization through selective asset enhancement, cost savings, and a focus on core quality assets will remain the main strategy. Guidance is cautious for overseas markets given persistent volatility and weak currency trends, but optimism persists for long-term asset value growth. Most distributable income is hedged or derived from Singapore operations, greatly reducing the risk from exchange rate swings. Key risks and challenges were highlighted in the earnings report. First, macro risks like trade tensions, inflation, and global economic instability could affect consumer demand and tenant retention. Currency headwinds remain material, especially with a strong Singapore dollar. HK and China markets are challenged by policy changes, and excess new supply in pockets may pressure rent and occupancy rates. The trust continues to monitor cost inflation and adapt contracts to minimize exposure. What should investors take away from this? MPACT's stable DPU, strong Singapore asset base, and prudent financial discipline offer confidence for long-term holders. The REIT's sustainability focus and portfolio optimization add value beyond just quarterly results. For risk-aware investors, vigilance is needed regarding overseas exposure and economic shifts, but the bias toward stability and measured growth points to a steady future. As we wrap up, ask yourself, will Singapore continue to serve as a safe haven for REIT investors in 2026? How will asset enhancement and portfolio optimization shape MPACT's next phase? Drop your views in the comments, like and subscribe for more deep dive financial analysis, and share this with anyone tracking the SGX market. Thanks for staying with us. See you next video.